There we go. All right. Well, good afternoon, everyone. Welcome to our Cannon Wealth Management Outlook 2025. U.S. economy and equities set to lead again, and we have a lot of exciting information to share. It's a topic that we this time of year in our profession sit around and talk about quite a bit, and thinking about the new year, thinking about the markets, the economy. What's going to happen? Is it going to go down? Is it going to go sideways? Is it going to go up? What's going to happen this year? Of course, forecasting is definitely not something that we can do with definity. We don't have a crystal ball. I thought this was an interesting quote that I read from economist John Kenneth Galbraith. He said, those who don't know and those who don't know, they don't know. He said there's two kinds of economic forecasters, those who don't know and those who don't know that they don't know. So I thought that was a good quote, and certainly we don't know the future, but we're excited to look at some economic data that is real data that can give us some indicators of what this year might bring. And I want to say real quickly, shout out to Kimberly Stone. Thank you for being behind the scenes and keeping all these things, the wheels on the bus rolling, and doing all the behind the scenes work. So thank you, Kimberly. And certainly I want to thank my guest, David Gullison, Vice President at Franklin Templeton, Senior Advisor Consultant and Vice President at Franklin Templeton. I'll formally introduce you a little bit later on, David.
Thanks for having me.
But I'm glad you're here. And David just flew in from Mexico. So we'll call him Snowbird today, Mr. Snowbird. But he spent a few days down south. And how was it?
It was fabulous. As a matter of fact, I heard Trump declared remain in Mexico after the weather we had last night. I should have remained in Mexico for another 24 hours.
You should have abided by that order, right? And of course, all of us are thinking right now, especially of warmer temperatures. What was it like getting back into Raleigh, right? And the 12, 13 degrees, something along those lines?
Yeah, so yesterday morning, I woke up to watch the sunset over the Caribbean. It was about 82 degrees at 7:30. So 82 degrees at 7:30 and about 15 degrees in RDU last night at 9 p.m.
9 p.m. Well, we're just glad you came back. I mean, I don't know that I would have, but thank you for being here with us. And we certainly have had a wonderful working relationship with Franklin Templeton over the years. 20 plus years that I've been working with Franklin Templeton with my clients and our firm as well. Certainly we have a long history and of a great partnership. So I'm going to go ahead and share my screen and we'll get started with the slides. And let's see here. Share. It should be that one right there. Okay, good. All right. So we'll jump right in. How many have heard or seen the movie Curious Case of Benjamin Button? You might have seen that movie. Of course, I don't want to spoil it for you, but if you haven't seen it by now, I think it came out in 2008. so I'm not sure what to tell you, but of course, Brad Pitt and Kate Blanchett. It's an interesting story about a little boy who was born old, right? And as he aged, he got younger looking. And just a fascinating story. It's a good film. But reason I bring that up is I feel like we're in the Benjamin Button economy in some ways. Certainly economic cycles, you can generally trace them. You can generally see, a contraction, a recession, a strong expansion until we eventually see a peak in economic data, and a lot of times the market kind of follows this, and then followed by another contraction, and then a recession, and then followed by it's just a cycle that we go through. But in this case, it looks a little different. Yeah. I think certainly we've seen the recession of 2020 caused by the pandemic. We saw a clear expansion after that in GDP numbers, as well as the market really roaring back. We saw what you might argue was a peak in economic data. And then we've seen a slowdown, a contraction of sorts.
Yeah, 2023, we did see some pretty significant slowdown in the economy, and it seemed to look that way heading into last year. And we'll talk about how things have changed after that.
Absolutely. So recession is next, according to the general cycle, but we're going to talk about that. And I know you have some great data on what we're seeing right now in the economy, what seems to indicate strength, and what seems to indicate that we might actually be, while aging, actually looking stronger and looking younger, maybe. And so we're going to answer three questions today. What is the current state of the U.S. economy? What do key economic indicators tell us about the risk of recession in 2025? And which opportunities currently appear most attractive for investors? And so we'll go ahead and dive right in. A lot of good data here. And I'll click on this to try to get us to the next slide. We are going to try to keep you on track here. Try to be done by 5. We're already a little bit off of our agenda, but we'll start out with some comments from Cannon Wealth Management and our outlook, and then we'll dive right into some additional insights from our trusted partners at Franklin Templeton, and then we'll close out with a Q&A session. So if you do have questions along the way, please type those into the question and answer field there on your Zoom system, and we'll be watching for those questions, and we'll try to get to them at the end. Sound good? All right. Right away, we'll jump right into GDP and inflation. These are a couple of areas that certainly have been in the headlines, been in the news quite a bit, especially inflation. U.S. real GDP posted solid growth in 2023 and 2024, despite facing the largest federal funds rate hikes in 4 decades. And several factors have propped up that growth, including excess savings, asset price appreciation, strong government spending growth, and a factory building boom. But these factors will likely fade in impact, and the stress of high interest rates will accumulate over time, leading to a slowing GDP growth over the next 12 months. In terms of year-over-year growth rates, we expect a slowdown to a trough around the end of 2025 and possibly even into the beginning of 2026. But after that, we expect the effects of Fed rate cuts to kick in and drive some strong growth into 2026 and through 2028. So that's our overall outlook as Cannon Wealth Management. And of course, we listen to our partners. We have a lot of data that would support that. And I'm going to, in a moment, turn things over to David to give us some real good information behind that outlook. As far as inflation is concerned, inflation did reach its highest level in 40 years in 2022, as supply constraints combined with excess demand to drive up prices. But supply constraints have alleviated, and so the spiking of prices in energy, durables, and other goods is now unwinding. That inflation is really back close to normal in 2024, but we're still watching housing, and we're starting to see some leading indicators in the housing arena that seem to indicate that the housing inflation is starting to subdue. So this is all good news. Inflation's coming back down, and of course the Fed has started a rate cutting cycle. The next slide talks about rate cuts, and we do think rate cuts will continue. I think it's interesting. The market is actually kind of pessimistic about rate cuts. As you can see from the blue dots there on the screen, the market is only pricing in one rate cut this year. The Fed is indicating, if you take the consensus of the Fed chairs, the Fed economists, they have a consensus of the 2 stars there. So that's just kind of indicating where the Fed in general thinks things is going. But then we think rate cuts might be more. We don't know obviously what the Fed's going to do, but it's going to be fact dependent, as they often say. But our outlook is more aggressive as far as rate cuts go. We do think that that inflation will be subdued, that we'll get inflation under control, and there'll be rate cuts coming. So I'll let David speak more to that here in a moment. Just a quick idea when it comes to rates and interest rates. We don't know the direction of interest rates. We have some ideas what we think might happen, but certainly we can be wrong. And so a good strategy, depending on your situation, and obviously talk to your financial advisor about this, but a good strategy can be to ladder out your maturities. So maybe have a 1-year CD and a 2-year CD and a 3-year CD, 4 or 5, so that you've always got some money locked in at some longer term rates in case rates really do fall. You want to have some of your money locked in there in that scenario. I'll go ahead and share a little bit about where we are from a valuation standpoint. So the stock market, the equity markets are trading at a premium right now to their fair value. However, not all of the stock market is trading at a premium. Certainly the large growth area of the market, generally speaking, not all, but generally speaking, is trading at a premium. But there are pockets of real opportunity in the value side of the market, and also in the small and mid cap areas of the market, especially in the value side of the market. So while we're not, building portfolios specific to style boxes, we do like to trim from growth when we see growth has done really well. And we also like to add to areas where we see opportunities. So this is something we're looking at, and we've already made some changes in portfolios to this to take advantage of small and mid cap value, and as well as large cap value. And some of you have probably seen that in some of your portfolios as we've made some tactical shifts. The market is certainly valued in a way right now that is interesting. There are pockets of the market that seem to be very high priced, but then there are pockets of the market and large areas of the market where we see real opportunity. The next slide illustrates this even more. Back at the end of last year, we started to see a rally in value in small caps that began in the third quarter, but then it was reversed somewhat in the fourth quarter. So again, growth has really done well, but value seems to be another area that is worth looking at. Again, we think inflation will resume a downward path in 2025. This is where we are with inflation right now. You can see the red line is your total CPI year over year, and then core CPI, which is excluding food and energy, is actually the red line. I'm sorry, I was looking at that backwards. The blue line is total CPI. The red line is core. Core is, again, excluding food and energy. It's a more stable indicator because food and energy tend to bounce around a lot depending on what's going on in agriculture and in the oil futures and all the ups and downs of the oil market. So we look more at core CPI, and we can see that core CPI has started to drift upward recently, and that scared some people. I think there's a lot of nervousness out there about, is inflation coming back? We don't think so. We think it's temporary. We think that certainly the Fed is watching it closely, and they can raise rates if they need to, but we think they're being very aware of where inflation is. Certainly a lot is dependent on what happens with tariffs and with some of the policies that are coming out now. But inflation, we think, will resume a downward path in 2025. And then I'll end on this slide and turn things over to David. But the rate of economic growth is slowing. It is slowing in the last few quarters, but we don't see recession. We think we will avoid recession this time. Again, the Benjamin Button economy potentially, as even though we've been aging as an economic cycle, we see things actually strengthening as the Fed continues to cut rates and as inflation remains tame. So with that said, I'd like to introduce David, and appreciate you being here again. Been in financial services 1993. Joined Franklin Templeton in 1997. Prior to joining Franklin Templeton, he spent 5 years as a financial professional with Payne Weber. And David works very closely with financial advisory firms like ours. He does a great job of bringing us ideas, letting us know what his analysts and economists are talking about. Really a wealth of industry knowledge. He's been with Franklin Templeton for quite some time. Did earn a bachelor's in science from the University of Florida.
Go Gators.
Go Gators, I guess. Here in the South, we take our college sports pretty seriously, don't we? I'm a Duke fan, so I have to say we're doing okay this year. But when we face you guys in football, it's always scary. He holds FINRA Series 7 and Series 63 licenses, and he is a certified investment management analyst. So appreciate all your hard work to get that designation. I looked into that at one point. That's a pretty serious designation. David currently resides in Raleigh, North Carolina, with his wife, and we'd like to also hear a little bit more about Franklin Templeton, if you don't mind.
Yeah, sure.
So share with us about Franklin Templeton, and then we'll dive into some thoughts on the market.
Yeah. Good afternoon, everybody. Thanks for having me. So again, my name's Dave Gullison. I've now been with Franklin Templeton, actually December. Can't recall if my anniversary was 27 or 28 years. That's how long I've been with this organization. And at no point during our talk here today, I'm going to kind of try to share some of our best thinking of, where the opportunities lie going forward. But I do want to share some, background of my organization. I was thrilled to join Franklin Templeton at the very end of 1996. And at that time, we were Franklin Templeton Mutual Series. Mm-hmm. Okay. And I thought it was the greatest thing. And that lasted for about 20 years that I could represent Franklin Templeton Mutual Series. Three of the biggest pioneering shops, Franklin Income, Franklin, from 1948, we pioneered bond investing and muni investing. We brought one of the most successful income generating strategies to Franklin Income, which has been around for 75 years. Mm-hmm. Then we merged with Templeton, started by Sir John Templeton, who literally pioneered global investing. Mm-hmm. And then there was Mutual Series, our deep value specialist. So I didn't think it could be any better until 2020, when it was announced that we were merging with Legg Mason. Mm-hmm. So here we were, 850 billion, merging with Legg Mason, 850 billion. Becoming $1.5 trillion overnight, now allowing me to also represent Western Asset Management, Clearbridge, Royce on the small cap side, the largest small cap only, Brandywine on the fixed income side. Mm-hmm. So if I didn't think that could get any better coming into last year, Putnam was rolled into the fold. Yep. So it's a very exciting. So what we're going to share as we go forward is nothing specific to any investment. But if you take that collective investment prowess across all of these fund companies, which now reside under the umbrella of Franklin Templeton, I'm basically going to share, basically a survey of 450 PMs of our portfolio managers and where we see things going on a go-forward basis, as well as, where we think some of the sweet spot in investing might lie. So before we look forward, I've always felt it was important that we take a collection of where we've been. Mm-hmm. And I think to be a successful investor, one needs to be a student of the market. Otherwise, we're going to fall prey to the media. The media expression, if it bleeds, it leads. And it's kind of interesting what psychology has learned, that any threat to your money is basically taken as a threat to your physical body. Mm-hmm. So the media knows this fight or flight. And if they can scare you about your money, you're going to stay through the commercial break. So the more we can be a student of the market, I think the better we are being successful investors. And let me share some things there, and then we'll kind of take a look into the future. So let's talk about panic attacks. It was great to wake up in Mexico to have a breakfast of tropical fruit. Yeah. It was absolutely terrifying at 9 a.m. to be flying in a whiteout snowstorm into RDU. Mm. So, as an investors, we're not short of, panic attacks either. The fact of the matter is, the world's going to happen. I won't say the word, but it happens. Yeah. And, bad things, unexpected things happen in the world, in the economy, certain things pop up. And the market, does overreact at times, but the market acts as a discounting measure. So in the very short term, we see things happen. The market corrects to discount for the potential, but we always have to think in terms of being a long-term investor. here, what I'm showing you as you look over here, let me see if I can get my laser pointer to work here. All the various panic attacks and where the market ended up bottoming out. Let's go back to where's Y2K, because that was always a fun one that 1990, it's all the way up here. So, for fear that the computers were all going to stop working, we saw the market bottom out. It dropped 12%. A lot of people panicked and pulled all their money out. Now, had they left that money there at the bottom, we would have seen that grow over 250% by now. So it's important that when these things happen and you see that market, volatile correction, that we don't panic, that we don't overreact. Oftentimes we've eaten all the downside, and unfortunately, that's when a lot of people pull their money out. And then they wait for everything to look great again, and they put their money back in, only to have some other event cause trouble. And it's this kind of wash, rinse cycle over and over that kind of leads us to this. So if we look over the past 20 years, you'll see that the S&P 500 essentially averaged 10%. Now, 10% is the return you need to double your money every 70 years. So over the past 20 years, the market compounded at 10%. Well, that would have been enough to take your 100,000 and turn it not just to 200, then to 400, then to $800,000. I mean, that's what a 10% compounding over a 20-year will do with your money. If we just, first of all, not all of us can take all the volatility of the market, but what we need to do is customize a portfolio that meets who we are, that will meet our return expectations, but offer us the downside. But once we get there, we kind of need to stick with it. And we can see that if we look over the past 20 years, what's the average investor's experience for investing in stocks? Basically less than inflation. And it was that panic, get out. Oh, feel good. Now buy high, sell low. We need to pick our risk tolerance, pick our goals and objectives, and we need to stick with the portfolio. And the portfolio does need to be tweaked here and there. So that's a message I have there. Right now, there's a little bit of, I was hearing this a couple months ago. It's like, but we're at all-time highs in the market. This now can't be a good time to invest because we're at all-time highs in the market. Well, what you're looking at here is in blue is where the market was 12 months after an all-time high, or 3 years after an all-time high, or 5 years out from an all-time high. So it turns out that investing near the top of the market has actually been one of the better strategies. But you don't get to pick the high. You don't know where we are. That's why I like this, all periods. It's always a good time to be an investor for the long term. On average, we see the market 1, 3, and out. So we kind of have to leave that. Well, where's the market? Is the market, we're at all-time high? Now is not a good time. Something I've been hearing a lot lately is, wait a minute, we've just logged back-to-back 20 plus return years in the market. As if that means what?
Yeah. Yeah. I've heard that a lot recently as well. Absolutely.
And we're hearing the media. It's like, whoa, we've just logged 2 back-to-back 20%. And what? Well, what we're showing you here is, if we look back in history, this isn't the first time we've logged back-to-back 20 plus years. And I'll even show you something further in a few minutes. But typically speaking, on average, after logging back-to-back 20, the market's still up around 12%. And a lot of people, back-to-back 20, that means we're set for a down 20 or down 30. Well, quite frankly, it's never happened. So let's be careful with some of these, things. Politics has clearly been in the news. And, heading into election, it seemed half people didn't think they should be an investor because the other side might win, or vice versa. But the reality is, politics really don't matter. It's the economy. And we are very, this is America. We're very intuitive, and we work hard, and we're seeing massive productivity gain. So let's kind of leave politics out. That's another reason why you shouldn't tweak your portfolio depending upon which direction you think things are going. All right. A lot of talk right now around tariffs, and what does tariffs mean? So, I'm hearing a lot, tariffs are going to be very inflationary. Well, we had Trump 1.0, and it wasn't inflationary at all, quite frankly. So here we're looking at Trump 2.0 with tariffs. So if we look back to the first administration of Trump, the idea that we might be heading into somewhat of a trade war, if you will, did leave the market to kind of trade sideways for a while to digest what that means.
Right.
And just like last time, the tariffs are more of a carrot and a stick at the end of the day. And once the market realized, we did proceed after that. So I would say, right now, I think there's a lot of things to digest. We've just gone from a Fed tightening rates extremely aggressive, making money very expensive, to beginning to ease. Big fears of inflation, which now seem to be giving way to expansion. So I have a feeling over the next 6 months, we could be in a period where there's a lot to digest. But we have to, again, look at the overall direction of the economy, which seems very positive, and I'll point to that as well.
Certainly. And anytime we show a pattern from the past, we always have to remind folks that certainly doesn't mean that this is going to happen again. One thing we have kind of going for us is the fact that we've been through this once before. A lot of what we're hearing in Washington, we've been through before, and it could very certainly or very possibly be different this time when it comes to the market's reaction to the tariffs.
Yeah, another thing that we saw as well last time is when there is talks of tariff, that tends to lead to a very strong strengthening of the dollar, which actually is very supportive of domestic economic growth as well. All right, so here's one of my favorite slides. Every time I get a chance to this is my ultimate be a student of the market. So of all the talks I've given, from Medicare to Social Security to the economy or education planning for one's kids, this slide gets in there because I think this is one of my most important. So if we look at the history of the market, we look back 73 years. What we have here, I guess, the gold are the positive years, and what we have here in the blue are the negative years. And one of the things I want to point out to you is the fact that the markets are positive much more frequently than they're negative. History has shown that 70% of the time the market's positive, 30% of the time the market's negative. So what would I tell you about the next 10 years? Probably have 7 positive years intermixed with about 3 negative years. And if you look at any snippet of 10-year history, what do you see? About 7 positive years and 3 negative years. Now, furthermore, of the 73 positive years, nearly 60 of those years saw a return in excess of 10%. Yet, of the 26 negative years, better than half of those losing years were less than 10%. So the markets are positive much more frequently than they're negative. And we tend to make much more money to the upside than we do in that 30% of the time the market's negative. Now, what's had people miss so many of these, there's 58 years, 53 years that saw a return in excess of 20%, are kind of these 6 where it's over 10 or this 6 where it's more than 20.
Yeah, it really is shocking when I look at the slide because, I study the market and I this is what I do for a living. And yet I didn't realize that over, the largest bar on this graph would be the greater than 20% gain.
Right.
I would have thought it would have been a large part of the graph, but not the biggest, and not the
Right.
biggest by almost twice of the nearest competitor. So it's shocking when you look at it, how many years are over 20% gain.
Yeah.
So, yeah.
Yeah. And furthermore, so let's look into these truly ugly years. Now, if we look over these years, interestingly, what do they all have in common? They happen to correlate to recessions. So bad things happen in the market during recessions.
Mm-hmm.
So the question is, how likely is it that we're imminently going to see a recession? I'm not saying that this year, after 2 positive 20 years, we can't see the markets down for the year, but recessions are likely to drive a really bad year in the market. Mm-hmm. So how likely is a recession? Now, this is our economic outlook program. The name of it is Anatomy of Recession. The whole point is, how likely is it that a recession is imminent? Well, the heart of our program is this economic dashboard, which is comprised of 12 leading economic indicators. So leading economic indicators means it's looking into the future. Now, we chose these 12 because they've been around for a very long time. They're very sensitive to changes in the economy, and they do so with enough time to make that information actionable. So you can see since June of last year, kind of a mixed bag of leading economic indicators. Quarter by quarter has gotten actually stronger and stronger, to the point where there's never zero chance of a recession. But basically our feeling is it's about an 87% chance of no recession. I'll give you just one example, and it's really pertinent to all of these. But take housing permits for a minute. So if you sign a housing permit, you're basically signing on the dotted line that you're about to turn a piece of dirt into a house.
Yeah, you're about to lose your mind.
Yeah. You've just found someone to lend you $500,000 to turn a piece of dirt into a house. So over the next 6 months, think about that transformation from dirt to house. Okay. There's a lot of framing and people that need to frame that house. There's a lot of roof shingles and work for people to put them on. There's a lot of wire that needs to be strung, plumbing. There's going to need to be grass. You're going to need utilities and carpet. So essentially, think about the momentum. That $500,000 that you secured is going to be dumped into the local economy over the next 6 to 9 months. So that's an indication of, if more and more people are signing housing permits, that's a positive leading economic indicator. And you can see that as of December, that indicator is now gone expansionary again. So furthermore, this is just kind of where we've been over the past half a year, strengthening of the economy. Okay, what you're looking at here is on the far left is where we sit today. Okay, as you can see, overwhelmingly green, a lot of green on that, but the rest are the 8 previous recessions. So this dashboard, as an indicator of what we're likely to see, this dashboard was red prior to the start of 6 of the last 8 recessions.
Yeah, and the one just to the right of it, 2020 was somewhat of an anomaly because it was induced by a pandemic.
Yep. So 2 of the past 8 recessions, here we had 73, 74, and 2020. In both cases, the dashboard was yellow, leaning red. Oil prices quadrupled overnight, threw us right into recession. Yellow, leaning red. The pandemic threw us right into recession. So as it stands right now, how likely is it that we're going to see a recession imminently over the next year? We don't think it's very likely whatsoever. All right. So here's something that I'm not going to say alarming, but I think it's something it's important to note. So when we talk about the S&P 500, if I was to ask anybody, what do you think the S&P 500 is? Most people would think, well, it's 500 companies from the largest to the smallest, from industry A to industry Z. It's kind of average of how they've all done over the past year. Well, that would be logical, but that's not what the S&P 500 is. So the S&P 500 is market cap weighted.
Yeah.
Market cap is market capitalization, meaning how big you are. Yeah. So the bigger the company, the larger the percentage of the S&P 500 it represents. Right. And when we say S&P 500, I don't think many people realize that the 10 largest companies are now 40% of the S&P 500.
It should be called the S&P 10.
Yes. And this is not common. I mean, this is almost as concentrated as it has ever been.
Right.
Now, how did we get here? Okay, so if we look at those 10 largest, oh, by the way, oh yeah. So this is even a little bit funnier. So we talked about the S&P 500. There's something also called the ACWI index. It's the all country world index. It's like the S&P 500 of the world. Mm-hmm. And if you look at, say, okay, well, what percentage of the world index, when we combine the Chinese companies and the French companies and the Canadian companies and the UK and Japan, what do those companies represent of the ACWI? About 16%. Yeah. The Magnificent Seven, represents, 21% of the world index. So we're looking at some real massive concentration, in these names. Now, how did we get here? All right, well, if we look at 2023, I honestly think this might have been a recession that they didn't call a recession, because outside of the Magnificent Seven, you take the other 493 companies, they actually on average saw their earnings contract about 5%. If you take the Russell 2000, which is the index of small and mid-cap companies, they actually saw double-digit earnings contraction. But those Magnificent Seven, the Apples, the Teslas, the Nvidias, the Microsoft, with Google's, Amazon, Facebook, they grew their earnings 35%. So why did all the money go into those seven? How did we get to that concentration? That was the only place to get any growth in 2023, which we saw continue over to last year. And halfway through the year, all the money was going back into those seven companies. Why? Because it was so much more attractive than any other stocks. Certainly that's in the US market, and it was worse everywhere else in the world. But something interesting happened in the middle of last year. I started to look towards 2025. And what we start to see is these seven companies that were the sole driver of earnings growth are starting to come into parity with everything else. So that begs the question, if the Magnificent Seven aren't growing as much as everybody else, are they worth twice as much? So one of the valuations we use is price to earnings. What's the price? How much do you have to pay for that company's earnings? And as it stands right now, the 10 largest companies, you're paying about 30 times earnings versus everything else around 18 times earnings. And that's still market cap. So we're looking going forward, the same amount of earnings for about half the price. What's even more interesting is if we say, well, let's look at the equal weighted S&P 500. Let's look at what's the valuation of everything if we looked at it equally. What we see is the market right now on an equal weight basis is trading at about 16 times earnings, which really is the average stock is the average price we would expect to pay. But yet I showed you, we're about to see a massive amount of earnings growth amongst everything else from a starting point that the average.
And what do you think that is the catalyst behind that? I mean, why do you think the shift from these large companies growing so fast and the slowdown there, and then the starting to see more earnings in these smaller companies? What do you think is driving that?
When we look at those Magnificent Seven, they're almost kind of independent of the overall economy. We have to remember, we just had a pandemic. We saw an absolute shutdown of the world's economy. The supply chains, which have now eased, it took its impact. It just seems to be, here we are heading into 2025. It's taken us about 5 years to kind of get all that behind us to now start to see everything else have the opportunity to expand. And the economic environment seems ripe for that. And these are some pretty inexpensive companies. So, where do we see some of the better opportunity going forward? I think that's a good question.
And I've also been thinking about the tariff argument. I mean, if the tariffs really, if we do find ourselves in trade war 2.0, you could see domestic, smaller companies really thriving or at least doing better in that environment. So,
yeah. So one of the areas, there's really kind of two camps of the world when it comes to investing. There's growth investing. These tend to be a little bit more exciting companies who are seeing their earnings grow more rapidly year over year. But that growth really isn't certain. It's we hope that earnings continue to go as they're going, because it's kind of exciting, kind of newer technology, newer things. But then there's value. I'll admit, value is maybe a little bit more boring. So these are more established companies. So think of healthcare, financials, industrial companies, materials, utilities. Now, a little bit more boring, however, much more consistent earnings growth going forward. much more stable companies. Well, as it stands right now, value companies compared to growth companies are trading really cheap. So I showed you, hey, if we look at everything, it's pretty much at the historic average. If we look to value, value's cheaper than it should be right now. And yet, the earnings growth in a lot of your traditional value industries, healthcare, financials, industrials, materials, they're actually expected to grow their earnings next year to the equivalent, if not better, than the Magnificent Seven, at a starting point of being very inexpensive.
So I know you know the answer to this question, but I'll just throw it out there to you. So do you sell all your growth stocks and buy value?
No, we don't. Investing doesn't that work that way. Yeah. We need to have an asset allocation in our portfolio. We always need to have growth and we need to have value. Mm-hmm. We need to have domestic. We should have some international, large and small. Yeah. So what we're talking about here is what we call tactical allocation. So strategic, you need to have that mix. Tactical is, how do you want to tilt it? Mm-hmm. And successfully, I know your clients have been leaned much more towards growth the past couple of years, and it's really helped in their portfolios. I'm not saying we abandon all growth and go to value, because I showed you growth is still going to be growing pretty nicely. But we probably want to, at minimum, get a balance back between growth and value. If not, put a slight tilt to value. Yeah. It's never a zero game. We're not betting here. We're making intelligent tilts to our core portfolios.
And we certainly have been doing that as we've been having these conversations, and also as a team internally, we've been moving folks, taking gains from growth and moving over towards value. We made quite a few changes in our tactical models in the last couple of weeks here. So if you have questions about that, certainly reach out to us, and we'll be glad to talk through that with yep. any of the listeners. So
now, some of the things I always kind of look for some exciting things. Yeah. So here's something I find particularly intriguing. Again, we want to be a student of the market, right? So what is being a student of the market tell me, might suggest to me? Doesn't guarantee, but being a student suggests. It's, what is it? The future never repeats, but it sure does rhyme.
Yeah.
Isn't what they say? So middle of last summer, we hit a point where value companies were now underperforming growth companies by 25%. Mm-hmm. Yeah. So if we go back to 1980, this will make the 35th time that value is now underperformed growth by 25%. Being a student in the market, when that's happened, 12 months out, value has significantly outperformed growth about 75% of the time.
Mm-hmm. Yeah, and certainly no promise of that, but it makes sense to pay attention to history.
Right.
I mean, history is a guide, right?
Correct. Mm-hmm. So value's cheap. We're about to see very significant earnings growth, which have been very much lacking the past couple of years. The value companies really took the brunt of the pandemic. Yeah. But we're at a point where we could see some really good things out of them. So we want to if we're talking about key success this year, it's going to be a broadening of market participation, not just 7 companies. We want to look more broadly. Looking more broadly, we can find much less expensive companies. And it seems that there's an opportunity in value, kind of a historic opportunity in value. So if I'm looking to value, what type of value might I want to look at? So what we're looking at here, this is a little busy, but what we're looking at here are dividend growers versus the S&P 500. Now, we at Franklin Templeton are we're very inclined to invest in dividend growers. So to us, another word for a dividend grower is quality. So to have a dividend, okay, you really can't be burdened with heavy amounts of debt. Okay. To have a dividend, you have to have earnings. No earnings, no dividends. Mm-hmm. So to have dividends that are going up every year significantly, well, you must have earnings that are also going up as well. And one of the things that we look at is we want earnings to be going up every year, but we don't want the company paying out more than half their earnings in dividends. So they're also generating free cash flow. So dividend growers in our world means quality. And what you would see is, this is what you typically expect right here, right? Dividend growers versus the S&P 500, the highest quality versus the lesser quality. And you generally expect historically the higher quality will outperform lower quality. There have been these brief instances in history where dividend growers, the highest quality, significantly underperformed the rest of the market. We saw that in 99. We saw it in 2022, only to see significant outperformance. Well, once again, we're at that point where the highest quality companies, which tend to live in the value world, have now underperformed the rest of the market.
Yeah, it's fascinating when you really look into the numbers. Certainly, dividends prove that there's money being made, but some companies will post a dividend just to kind of keep investors happy, but they're really in trouble. And so it's really important, as you said, to study the underlying fundamentals of the company as well. Just because it's yielding a high dividend doesn't necessarily mean. So it's important that you got somebody looking at that for you.
And I think, again, going back to being a student of the market, that people forget that if you look decade by decade by decade of the market's history, dividends have accounted for about 30 to 50% of the market's total return decade by decade. People have forgotten about the importance of dividends. The past 10 years, dividends contributed the least they ever have to the market's total return. We think on a go-forward basis, dividends are going to be much more crucial as that calculation of dividend and growth for total return. So let me kind of bring us to a close here. I'm hearkening back to one of the slides I showed you earlier, where I was showing that, hey, this Magnificent Seven, not quite looking so magnificent versus everything else going forward. But what I didn't point out is this blue bar, which is what we're anticipating in small and medium-sized companies. Now, historically speaking, we see 10-year cycles. Large companies, large caps outperforming small and medium, then a decade of small and medium outperforming large. We think that we're about to shift from the past 10 years of large outperforming small and mid to an extended period where we're going to see small and mid outperform large. And that seems to be backed up in expectations that we're about to see an explosion of earnings growth. Now, when the economy we're at a good pace, the economy is growing nicely, but it's not hot. When the economy tends to slow down, this tends to be a very good time for small caps, which do compound their earnings much greater. When we're talking about the potential of tariffs out there, big companies, 40, 50, Magnificent Seven, 60% of their earnings come from outside the United States. When it comes to small and medium companies, they generate all their earnings domestically. So they're not as impacted, by tariffs. And they tend to do very well as the Fed starts to cut rates. So we think we're about to start a cycle in small and mid caps, kind of like what I was talking with value. What's my starting point? Well, it turns out right now, small and mid cap companies are trading cheaper today than they ever have versus large caps. So if we look at the market cap weighted, again, it's 7 companies or 40% of the market, right? Well, if you look historically, the S&P 500 is traded around 16 times earnings, currently around 21 times earnings. It's really that Magnificent Seven that's driving it up. But nevertheless, that's the S&P 500. If we look at small caps, the average around 16. Where are we at right now? 16. But we're about to see some pretty explosive growth. So last but not least, I thought I was just going to leave this out. Something else I'll point out is the absolute amount of money that we Americans currently have in money markets and CDs. Yeah. So we have around $6 trillion basically sitting outside of the games of stocks and bonds. And past year and a half has been pretty nice. I really enjoyed my 5%, but that's quickly going away. And we probably shouldn't have $6 trillion sitting on the sidelines for this environment, which looks very conducive for economic and hence stock market and bond market performance. And putting that in perspective, if we look at the peak of the financial crisis, now this is pandemic really scared me. The financial crisis really scared because that's our industry. We have $2 trillion more than at the peak of the financial crisis. So we also think historically the Fed is in a cutting rate cycle while the economy expands. This tends to be Goldilocks for the market, for the economy itself. We think that there's not going to be real big pullbacks this year. We think that we should, if we have money to invest, buy into some of the dips. And we've actually seen the market pull back around 6, 7, 8% from our highs in December. So we're kind of in one of those that starts to attract this money from the sideline.
Well, I'm glad you guys are saying what we're saying. That's good. We're on the same page. Economic and market summary. I like this slide as well.
Yeah. So, in general, I started with the economic dashboard. And most of the leading economic indicators are now positively inclined towards growth. We still have a cash-rich consumer feeling good about their balance sheet, starting to feel good about job prospects going forward. So generally speaking, there's a lot of positive things out, not to mention that the Fed, be interested to see how much they cut this year. Probably not going to be cutting that much this year, but we're in a cutting cycle that's going to last over a couple of years. So all those are very good for the economies going forward. As far as the market outlook, 20, back-to-back 20%. Historically speaking, that means about an 8% or 12% return the following year. I did mention that there's a lot to digest. There's been a lot of excitement. There's a lot of anticipation, but it wouldn't surprise me if, over the next number of months that the market, it's going to take time. We're going to see the market up. We're going to see the market down. If the market seems to be selling off a little bit more than it should be, these are really good opportunities to get some of our monies back to work. And what was very narrow market the past couple of years, where all the return came from a handful of stocks, we think that's going to be broadening. That'd probably be our greatest investment theme for this year, is a broadening of participation in stock market performance.
Yeah, what I love about this slide is the arrow that is pointing up. So that's a key indicator there, right?
I guess I should have made it green to go along with the other ones.
Yeah, we cautiously optimistic. How's that? But it is remarkable. I mean, given all that we've been through the last few years, you would think we would be looking at a recession, or at least a significant slowdown. But I do agree. We do agree. We were having our quarterly meeting as a firm, even just yesterday, going over these very same subject matter here. And I believe at Cannon Wealth Management, we're on the same page with you. We may be able to avert a recession here, which would be good for everyone, I believe. I do have a few questions. Let me go ahead and, if you don't mind, click through the disclosures here. Our attorneys want us to make sure we show you these disclosures. So we'll scan through those. And of course, if you'd like a copy of any of this, just shoot a message to us in Zoom or send us an email, and we'll get you a copy of all of these slides. I want to make sure I say thank you for joining us this afternoon. And hopefully you have submitted some questions. Let me just dive in here and take a look. And if not, we have some questions that came in before the meeting that we can dive into. But let me just take a quick peek here. All right. Let's see here. This is always, I'm technologically challenged, my friends. There we go. And okay. I do not see any questions having been sent in through Zoom, but we did, like I said, we did have some questions that came in before the meeting. One of them this is a really good one. What is the biggest risk to the economy this year? we've talked about that as a firm, and certainly a lot of uncertainty out there with the policies that have been floating around, just kind of the wild card of what tariffs might do. But what are your thoughts on that? What do you think would be the biggest risk according to your economists there at Franklin Templeton?
Yeah, so they always say, because I always ask, well, what keeps you up at night? And they always say geopolitical risk. I'm like, well, yes, if a meteor crashes into India, that was unanticipated, and that would be bad for the economy. But I think one of the things in inflation, we feel very good with the direction of inflation. We actually think it's going to be, we're not as optimistic that inflation's coming down as much as the street thinks. We think it's going to be a little stickier, but still manageable and still heading in the right direction. That's one of those things that we've got our eye on is, inflation being a concern.
Possibility of maybe a rate hike.
No, we really don't think there's much of a chance of a rate hike. But with the Fed, as the Fed always does, when they're raising rates, they always raise them too much. And then they're too slow to cut. So we think the Fed actually probably raised rates a little too much. So a concern of ours, not that rates are going to go up, but if they get stuck at this level, that could have, because interest rates are the cost of borrowing money. And when money is expensive, that's a tax against the economy.
I think most of the certainly the folks here at Cannon, we believe that and feel that you'll have at least one more cut this year.
We're in the 1 to 2 cut.
1 to 2. Okay. We're along that same line. We're not sure, of course, nobody really knows for sure which way interest rates are going to go, but again, it kind of draws back to the point that it's important to lock in longer term rates if you want to own bonds or you want to own CDs longer term, because if rates fall, you'll wish you had, right? So another question here that I think is a good one. If we get tariffs, let's say into a trade war, will that really send inflation up? And I think you've already alluded to this, but like China, for example, big, even though they're not what they once were as far as a trading partner, still a big trading partner. What are your thoughts around inflation and tariffs?
Well, one of the things, and I kind of alluded to a little bit earlier, is last time when Trump was doing a little bit of battle with China in regards to tariffs, what did China do is they reduced the value of their currency by 20% to mute it out. So the dollar came stronger, evened out. It doesn't, I really think this administration is really looking at it as more of a carrot or a stick. Now, something I learned recently, Japanese cars just come directly into our country with no tariffs. I think the tariffs of American cars going into Japan, I think it's upwards of 40%. So I looked into that. I'm like, well, how is that stood? Well, we wrote that in 1948. We decided to give Japan an economic chance to get reestablished. So I think you're going to see a lot of that as well as, hey, you've got 30 or 40% on our stuff. Well, why don't we put 30 or 40% on your stuff? Oh, okay. Well, you make it zero on our stuff coming in. I think I think we could see some real positivity.
What about international investments? We have an opinion on that at Cannon Wealth that is cautious because of the potential strengthening of the dollar. And I don't want to answer your question for you, but what do you think about international? And are there any pockets of international opportunity that you really like?
In all honesty, we're really not crazy. It's easy to point. I could show you 10 charts that just show how cheap Europe is. Well, sometimes things are cheap because it's what they're worth. They're cheap. So we're looking at really nice. Actually, I saw your internal. We think actually GDP growth is going to be at around 2.75%. So we're actually thinking the economy is going to grow pretty significantly. I think the best thing that you can say about Europe at this point is they're more likely than not to avoid recession. That's about as exciting as you can get. Now, when you start to think of tariffs, those disproportionately hurt emerging markets. So again, I could show you 10 slides on emerging markets and how cheap they are. And we're just not as compelling, or how much earnings growth that we're going to see. I think collectively over the next 2 years, we're going to see about 45% earnings growth over the next 2 years out of EM. And you can say, hey, that's pretty strong. But if we look at US smaller companies, it's going to be over 100%. And they're cheap too. So, do I own international? I do. I don't own it in large percentages. And what do I like to own internationally? We don't have the cornerstone on those high quality dividend growers. So I'm always interested in high quality dividend growing companies around the world. We don't have a corner on those. And that tends to be the bulk of my personal investment international. Not thrilled overall.
Yeah, I think that's where we are as well. I mean, we do have a position internationally, but it's not emerging market. At least in our tactical models, it's not emerging market, and it's very high quality. Last question, and this is one that I actually wrote in here. I always like to hear opinions on this. If you had somebody who had $1 million in cash and they wanted to invest it, what would you tell them at this juncture?
Yep.
Yeah. Obviously, depending on their situation.
But let's say they have this $1 million. It's sitting in cash, and they're not going to need this $1 million to buy that house that they just signed a housing permit for over the next 6 to 8 months. Practically, if we're looking 3 to 5 years out, practically anything's a better alternative to cash at this point.
Okay.
So if I showed you cash and CDs versus very short-term government bonds versus intermediate term government bonds versus corporate bonds of high quality, low, any other type of fixed income following the first rate cut, which we've seen, all of those things are always better to be in over the next 2 years. If we do avoid a recession, following the first cut into an environment where it's not recessionary, practically everything on the equity side does better than cash as well. So again, we kind of talked about the Goldilocks. Things are expensive. Things aren't real cheap out there. Earnings seem to go in the right direction. Valuations aren't too crazy, but we certainly know the direction of money markets and CDs.
Yeah. And certainly talk with a professional financial advisor that you trust and put together a plan, right? Put together a plan to meet your goals. Certain people that have high net worths may not even need any stocks, because they already have arrived at where they want to be. So it's all dependent on your situation and what your goals are. But certainly at this juncture, we're right there with you. We think there's a lot of attractive opportunities out there. And dollar cost averaging, maybe looking for dips, looking for opportunities when the market gives us opportunity with a little pullback over the next few months. And we do think that's likely. Maybe a little more turbulence this year than last year, but turbulence is not a bad thing as long as you get where you're supposed to be, right? As long as as long as when you arrive at your new location, it's not 13 degrees, right? But we're glad you're here. But thank you so much for joining us. This has been a really good conversation. I've really enjoyed it. And David is, again, been a good partner for our firm and our Franklin Templeton. If you have any questions, please shoot them out to us in an email or visit us online, and you can put your questions in there. Check one more time, make sure there's not any questions out here on our chat feature or question and answer. I don't see any. So certainly reach out to us by email if you'd like. But again, thank you for your time. Thank you for visiting with us this afternoon. And if you want to watch the replay of this, we will have that posted for you shortly. Have a great evening. Good night, everybody.